Welcome to qiphyedu. Today we're looking at economics, paper 12, May, June 2021. All right, let's start. So for the first question, it says, a tourist visits the coast for a holiday. On the first day, she visits the local tourist office for information, goes for a swim in the sea, spends the evening enjoying the view of the coastline, and rents a campsite. And which activities involve economic goods and which involve free goods? So let's take a look at the four options. A, it says camping and information. So it says, okay, let's see. It says local tourist office for information. So if you go to a local tourist office to get information, the office itself needs to be built, which means that it will result in an opportunity cost because of scarce resources, and you need to pay a salary to the officer to get the information. So this means that it falls under economic good. And then camping, you need to rent a campsite, so it falls under economic good as well. So this one will be correct. And free goods, it says swimming and sightseeing. Swimming is a free good because if you swim in the sea, it will not reduce the amount available to another person. And for sightseeing, sightseeing is considered a free good because if you want to see the scenery, it's not going to reduce the quantity available for another person. So it's considered a free good. So this would be correct. B, C, D, the reason why it's not correct is because they are just categorized in the wrong way, categorized in the wrong places. So information and swimming falls under economic goods, which is not correct. Swimming should fall under free goods. And C, it says sightseeing and camping. Like for sightseeing, it falls under free good. And then swimming and sightseeing both fall under free goods. So B, C, D is not correct because of this. Question 2, which aspect of a planned economy might be viewed unfavorably by a consumer but favorably by a producer? So this is a planned economy. So A, it says a bureaucratic system of decision making, which means that everything is decided by the government. This would be a lose-lose situation for both the consumer and the producer. And B, it says a long response time to changing economic events, which is also not a good idea for consumers and producers, mostly for producers though. And then C, it says an absence of incentive to work and to produce, which is not favored by a producer. And D, it says an emphasis on the production of capital goods, which would then be viewed favorably by a producer, because if you were to emphasize on the production of capital goods, this means that you can be able to maximize the profit by selling more quantity of that particular good. But then you will not be this is not going to be viewed favorably by a consumer because there will be a decrease in consumer goods, so they will not be able to maximize their satisfaction. So answer is D. Question 3, if the rate of inflation rises from 2% to 28%, which function of money is likely to be most affected? A, it says medium of exchange. It will still function as a medium of exchange, so it's not correct. B, it says standard for deferred payment. It will still function as a standard for deferred payment, so not really correct. Unless it says something like hyperinflation, then people will have to abandon that currency, but still, it's still money after all, so technically it will still be used as a standard for deferred payment. And C, it says store value. Yes, it would be affected because the value will decrease. And D, it says unit account, which would not be really affected, so I'd say C. Question 4, which statement will be classified by economists as a positive statement? So positive statements are statements based on facts and they are actual and can be tested. A, it says balancing a budget cannot be more important than reducing inflation. So that means the person is saying that reducing inflation is more important than balancing the budget. This is based on personal opinion, so it's a normative statement. B, it says maintaining the real income of pensioners need to be a priority, which is a normative statement because, first of all, if you were to maintain the real income of pensioners, they don't even have an income anymore to begin with. They have already retired, so they're not doing any production, so they'll end up just having to wait for, let's say if they really need for welfare payments and all those, they have to increase, but it's not the income, but more like welfare payments, so it's a form of transfer payment. And C, it says the government should increase indirect taxation for whatever reason. This is also an opinion. And D, it says the government will not increase direct taxation, which is testable because it says that the government will not increase direct taxation, set by the government, not by a person. Not like the government has already said that they will increase direct taxation, will not increase direct taxation. It's not the person that said it, but the government. So this could be tested, so it's a positive statement. And question 5, which statement about price elasticity of supply is correct? A, it says it cannot change in the short run. It actually can be changed in the short run, so it's not correct. And B, it says it increases as the time period lengthens, which is correct because as you can see, let's say my supply curve is here. The PES would be more than 1, right? But it will increase as time period lengthens. So yes, this is correct. And C, it says it is infinite in the momentary time period, which is not correct. And then D, it says it is 0 in the long run, which is not correct. It will increase as time goes on, so it's not 0 in the long run. Question 6, the price elasticity of demand for a firm's product is equal to 1 for all price changes, and what will be the result of this? So this means that the price elasticity is basically unitary, or PED equals to 1, and that means that regardless of what price is set, the item at the total expenditure will always be the same. So A says a percentage increase in price will cause demand to fall by a larger percentage. This means that the PED should be elastic, which is more than 1, which is not correct. B says a percentage increase in price will cause demand to increase by the same percentage, which is not correct. Because every time when there's an increase in price, it will result in the demand to decrease because the demand curve is downward sloping. So if let's say there's a percentage increase in price and then an increase by the same percentage, this is not what a demand curve would be like. It will be the other way around. It will be a decrease in the demand. C says quantity demand will always be the same whatever price, which is not correct. This means that the good is inelastic, perfectly inelastic. And then D says the firm's revenue will always be the same whatever price. So that's correct because total expenditure would basically be the firm's revenue. So answer is D. And question 7, what leads to a downward shift of the normal supply curve? A downward shift will be something like this. So you have your supply curve, demand curve, your supply curve shifts to right. So that means that there is basically less COP. So A says a rise in the cost of transporting goods. This one will lead to an upward shift. B says a rise in productivity will lead to a downward shift. And then C, a rise in the rate of sales tax would lead to an upward shift. And D says a rise in the wage rate, which will result in an upward shift. So answer is B. Question 8, the market is an equilibrium of 100 units of the product sold at the price of $10. The price elasticity of supply for a product is +2 and the price elasticity of demand is -1. So what will be the state of the market if the minimum price of $11 is imposed? So we know that the PS is 2. So what we can do is we can then calculate the QS over percentage change in price equals to 2. And percentage change in price would be 11 minus 10 divided by 10 because 10 is the base price. And then we can move it over. This one of time we have to times 100%. So percentage change in quantity supplied, you'll get something like 20%. So 28%, that means that there will be 120 units. But we have to calculate the QD. The QD would be negative, the PED will be -1. So percentage change in QS, QD would equal to -1 times 10%. So 10 will get -10%. So there's a decrease by 10%, meaning that the quantity demanded will be 90 units. So now we know that there is only 90 units of quantity demanded. So we take the original equilibrium demand, which is 100 minus 90, and then we'll get 10 units. And then now we know that there is 120 units of quantity supplied. But then now we need to calculate the surplus. So there will be so the surplus will basically be the excess supply. So 120 we need to add by 10, we get 130 units. This means that there is an excess supply of 30 units. So it's not excess demand, but excess supply. So answer is D. Question 9, the diagram shows the market for meat in equilibrium at X. The cost of producing meat rises, and there is a trend for consumers to change from meat to a vegan diet. And what is the new market equilibrium? Cost of producing meat rises, COP increases, so supply curve shifts to left. There's a trend from consumer change from meat to a vegan diet, so demand curve shifts to left. So answer is A. Question 10, good X and Y are complements. What will be the effect on the equilibrium price and quantity of good X of an increase in the supply of good Y? An increase in supply of good Y would mean that the supply curve shifts to right, something like this, price will decrease. This will result in your complement to have an increase in demand, which will look something like this. The increase in demand would result in an increase in price, so equilibrium quantity increases, equilibrium price would increase as well, so answer is D. Question 11, a private company achieves a producer surplus at the market equilibrium price, and what might reduce its size? A says private companies choose to prioritize profits. This will not reduce the producer surplus. It will prioritize profit. And B says private companies start to pay dividends out of profits, which also will not result in a decrease in size because the producer surplus is basically measuring the area between what the producers are being able to pay to supply the particular product, and also what the producers are actually getting the price that the producers are actually getting. So it's not because it will not be affected when the companies start to pay dividends. It just won't happen. And C says the government fixes the price of electricity below market price, which is not correct because electricity is basically mostly supplied by the government. So here it really says it's a private company, so it has nothing to do with this. And D says the private company supply curve becomes more elastic, which would indeed reduce the producer's surplus because it will look something like this. So this is what happens if it's more elastic, and this is what normally it should look like. So So this is the area of producer surplus, but after it becomes more elastic, the area now becomes much smaller. So yes, the producer surplus will decrease if it becomes more elastic. Question 12, how would an economist establish the market demand curve for private good? So market demand curve will basically be adding up individual demand curves horizontally. For answer is B. Question 13, knowledge of which combination of demand elasticity will be relevant to a firm. So PED would then be important to determine whether or not your good is a necessity or is it elastic? Or is it elastic good? And your cross elasticity of demand will be used to calculate the good and the other good will be complement or a substitute. So this is also important. And then you also need to determine whether or not your good is an inferior good or is it a normal good. So yes, answer is A. Question 14 will definitely stop following the nationalization of the industry. So nationalization of the industry, meaning that we are changing this private entity into a national company. So A says dividend payments to the industry shareholders will definitely be stopped. And B says job losses, this will not happen because the primary aim of nationalization is to get more job opportunities for people. C says price increases for the industry's product, which is not going to happen for nationalization. The price will decrease. And D says the closure of unprofitable factories in the industry, which would basically not happen because the reason why there's nationalization is to save these sunset industries or unprofitable factories in the first place. So answer is A. Excuse me. Question 15, the diagram shows the effect of the government introducing a subsidy and what are the effects of the subsidy on government spending and consumer spending. So for government spending, you need to calculate the area between area of this entire thing, which is you need to multiply quantity sold, the current quantity sold, and also the difference between the original price and also the subsidized price. So that'll be 4. So 4 times 120, you get 480 million. So AB is wrong for government spending. And then for consumer spending, you need to calculate the original quantity and then the original price, and then you need to calculate the subsidized price and then the quantity that is demanded later on. So originally the quantity demanded and also the price should be $10 times 100 million, so you get 1,000 million. And then the subsidized price and then the quantity would be 8 times 120, so you get 960. I get 40 million. So answer is C. Question 16, in the diagram, S1 and D1 are the initial supply and demand curves. What will be the new supply curve following the removal of an ad valorem tax? So ad valorem tax would look something like this. So this supposedly should be like this, but ad valorem tax will be like this. This one will be parallel. This one will be the specific tax. Like it will be imposed like $20 for every single price increase. This one is like a specific percentage. This will be an ad valorem tax. And then here, if it's a shift to the left, this would mean that it's wrong because you're removing tax, meaning that the COP decreases. So A, B is neither A nor B will be correct. So it's either C or D. But if you shift to C, this means that it's specific tax because it's parallel. D is not parallel to S1 though, so this one will be the answer. I'll say it's D. Question 17, the table shows sources of government revenue in a fiscal year for an economy and what is the total amount of tax revenue raised by indirect taxes. So sale of government assets would result in indirect taxes. Tax on self-employed is a direct tax. Carbon tax is also a direct tax. Corporate tax is also a direct tax. Capital gains tax is also a direct tax. Goods and services tax is an indirect tax, and air passenger tax is an indirect tax. So we add up 100 by 100 and 1,000, we get 1,200, so answer is A. Question 18, education from 4 to 16 years of age in most developed economies provided at zero price, financed from taxation, and why should the government do this? So education is now provided at zero price, meaning that it's a merit good. And the reason why it's a merit good is because it is under-consumed due to information failure. So let's look at the 4 options to see which one is the closest one. A says in the free market, consumers have imperfect information, so do not realize the full personal benefit of education, which is correct. B says in the free market, education is not considered to be private good, which is not correct. Now, it says that it is provided at zero price, financed from taxation. So an education would result in an opportunity cost. So supposedly it can be a private good if, let's say, it's provided directly by international schools, but then you have an option to send your children to a national school. So the reason why this is the case is because not many people pursue education. So in order to pursue education, people would have to, if let's say it's not subsidized, then they have to pay for it. but most people do not know the benefits of education. So in order to promote the benefits, they have to give it to people for free. And C, it says in a free market, consumers will be unwilling to pay for education, which is not true. It's just that they don't realize the benefits. So they probably may not be paying because of that. But it's not like they would be unwilling to pay for education. It's just that they probably do not know the importance. And D, it says in a free market, education not rival, not excludable, which is not correct. It is rival and excludable. Just that because of the fact that there's information failure, not many people know the benefits. Answer is A. Question 19, what will cause a movement along the aggregate supply curve? So let's say a rise in demand for exports. So it will look something like this. So AD curve will shift to right. And this is your AS curve. So yes, there will be a movement. B, it says a rise in the price of raw material. This will result in the AS curve will shift to left. Rise in productivity of labor will result in AS curve to shift to right. Rise in the rate of sales tax will result in the AS curve to shift to left. So answer is A. B, C, D all results in shift. A will result in the movement because of the AD curve shifting to right. And 20, the government devalues its fixed exchange rate, and what is most likely to be its aim? A, it says to improve the terms of trade, which is not correct, because if you devalue a fixed exchange rate, this means that the price of exports will now be relatively cheaper than your price of exports, or let's say the change in price will be relatively, like it will decrease at a higher rate than your import prices, let's say, for example. So this would make your terms of trade much worse. B, it says to increase the level of aggregate demand, which is correct. C, says to reduce the current account surplus, which is not correct, because if you devalue a fixed exchange rate, now the imports would be relatively more expensive, and so people would actually choose to purchase domestic goods instead. So it would not reduce the current account surplus. It probably may just stay like that. So like there'll be less there will probably be more inflow money than outflow, because of the fact that there is spendings are now used mostly for domestic goods in the first place. And D, says to reduce demand pull inflation, which is not correct, because your demand curve will shift to right. So I'll say B. Question 21, as part of its trade policy, the government subsidizes the cost of machinery used to manufacture goods for export. And how will this affect the balance of payments? So when you subsidize cost of machinery, there'll be more inflow money than outflow, because now you'll be able to you're now able to produce more of your exports, and then you'll be able to get a higher inflow money, and then you don't have to pay for the cost of the machinery, basically. So A, it says decrease the deficit of capital account, which is not correct. So B, it says decrease the deficit of current account, which is correct. C, D, it says they will increase the deficit, which is not correct. So answer is Question 22, what is correct about the causes of inflation? A, it says cost push inflation can be caused by a rising exchange rate, which is not correct. Because if there's a rising exchange rate, now the items that you purchase, or the COP itself, will actually be relatively lower. So it will cause a shift of the supply curve to rise, so this is not correct. B, it says cost push inflation can be caused by lower indirect taxes, which is not correct, because if you lower your indirect taxes, it will result in your AD curve to shift to right. Instead of causing cost push inflation, it will result in demand pull inflation. And C, says demand pull inflation can be caused by a rising exchange rate, which is not correct, because if there's a rising exchange rate, the AD curve will shift to the left. And D, says demand pull inflation can be caused by lower direct taxes, which will result in the AD curve to shift to the right. So answer is D. Question 23, the figures shown are from New Zealand's balance of payments for 2017 according to data published by Stats NZ in September 2018. And what was the value of the balancing item? So if you want to balance out everything, at the end of the day, the balancing item would then result in your value here to be zero, your balance be zero. But here you can see, for goods and services balance, this will fall under your current account balance, so we can just ignore this one. So you can see that for capital account balance, we need to add 7,600 from financial account. This one will get us 8,600 or 8,600. And then we minus capital account balance, so we minus 7,000. And then we'll get 1,900. Minus that, we get 1,900. So the balancing item will then be negative of this value, because we want to get 0. So negative of this value will be negative 1,900, so 23 would be C. Question 24, two statements are shown. One, it says a country can produce a good at a lower opportunity cost in another country. And B, and two, it says a country can produce a greater quantity of a good for the same quantity of inputs. So let's say a country can produce a good at a lower opportunity cost. This would be comparative advantage. And then a country can produce a greater quantity of a good for the same quantity of inputs. This means that this would be absolute advantage. So let's look at the options and see which one matches our criteria. So here you can see that there are some options that says terms of trade, which is not correct. So B and D are wrong. And A, it says absolute advantage. And then 2, it says comparative advantage. So, which is not the answer because, like I said, if it's producing one good at lower opportunity cost, that will be comparative advantage. But if you can produce a greater quantity of good for the same quantity of inputs, that means that it is absolute advantage. So answer is C. Question 25, the diagram shows the effect of the introduction of a tariff and what is the revenue received by producers of good X after a tariff is introduced. So good X, domestic supply originally should be at 80 million because it's at $10. And then there's the tariff, so it result in the price to increase to $20 and then the quantity supply to 100. So now, because of this increase in tariff, your quantity of X would be at 100 million, and then your price of X is at $20. So you multiply 20 with 100, you get 2,000 million. So that would be 2,000 million US dollars. So 25 should be D. Yep, so I'll say it's D because it's this entire thing. And then question 26, between 2011 and 2013, retailers reported that expenditure on domestically produced and imported goods have reduced. This is because consumers did not take out loans as the economy was in a recession, meaning that AD curve shift to the left. So what is the likely result of this? A, it says a decline in the deficit in the trade account. Yes, that's correct because there'll be more inflow money than outflow. And B, it says a decline in the level of savings, which is not correct. There is an increase in the level of savings. And C, it says a decline in terms of trade, which is not correct. You can't really prove this. And D, it says a decline in unemployment, which is not correct. You cannot really determine the likely result to be a decline in unemployment, because here you're just talking about expenditure on domestically produced and imported goods have reduced, and then the consumers cannot take out loans. So your AD curve would then shift to a left, and so your price level decreases, and so you would now reduce expenditure on your exports, and then your imports, and then that means that there will be more inflow money than your outflow, and so answer is A. Question 27, increased international competition leads to a worsening in the country's current account balance, and in the absence of any offsetting factors, how is this likely to affect the exchange rate and domestic cost push inflation? So a worsening in the country's current account balance, meaning that there's more outflow of money than inflow of money. So your exchange rate will now depreciate, because when there's more outflow money, meaning that your supply of your currency increases, resulting in a depreciation. And so your exchange rate depreciates and your cost push inflation will now increase, because the cost of purchasing goods from foreign countries will not increase. So your COP wouldn't increase, and then your AS curve will shift to the left. So cost push inflation increase, exchange rate depreciate. So answer is D. Question 28, why are higher interest rates together with increased taxation on expenditure likely to cause domestic deflation? A, it says contractionary monetary policy will override the expansionary fiscal policy, which is not correct. And B, it says monetary and fiscal policies would reinforce each other, which is correct. C, it says you also say override something something, which is not correct. Every word that says override is basically not going to be correct. And D, it says it will cancel each other, meaning there's no effect. So answer is B. And question 29, which policy aimed at correcting a balance of trade deficit is an expenditure reducing policy, reducing our expenditure? So A, it says depreciation, which is not an expenditure reducing policy. And B, it says increased direct taxation. Yes, this would be an expenditure reducing policy. And C, it says tax incentives for exporters, which is not expenditure reducing. And D, it says imposition of protectionist tariffs, which is also not correct. So answer is B. We are correcting a balance of trade deficit, meaning that we have increase in total volume of exports in general. So by increasing our direct taxation, we will then reduce our total expenditure on imports. And then for question 30, which policy will not cause a reduction in the rate of inflation? A, it says increasing income tax. this would result in a decrease in real inflation, so this is not answer. B, it says reducing government spending, this would result in reduction. C, it says reducing interest rate, this will result in a equal shift to right, so you increase real inflation. But if you remove subsidies, this would also mean removing government expenditure as well, so this one is not correct, so answer is C. Alright, this is the end of this paper. I hope you find this video helpful. Do share this video out to other people who may need it. And like I said in the previous video, this would be the last video for now. And there'll probably be new videos coming out, but that will be only until a few weeks later from now. Because I also have exams coming up. And so I hope this video has these series of videos have helped you guys out for the past few weeks. And I hope to see you again in the next video. Till then, this is qiphyedu.